All right, so this is going to be the only multifamily guide you will ever need. Everybody talks about why financial freedom is great with multi-unit properties, passive income, cash flow, all that stuff, making money on the beach, great. But nobody talks about how. So I'm going to cut through the BS, cut the fluff, and I'm going to get into from a lender's perspective on what to do when analyzing deals, managing risk assessment, getting the financing you need, and building freedom through real strategies that I'm going to go through. So I'm not going to have any fancy editing or anything like that. I'm literally just going to get right into it. My name is Ben Steff. I'm a licensed mortgage advisor, and I specialize in multifamily properties. What you're going to get out of this guide is a proven formula for analyzing these deals, actionable steps that you can start taking today to maximize profits and minimize risk, real world examples that show you how to apply these principles, high value insights designed to give you an edge over the competition, because a lot of people honestly just don't know, and practical, no nonsense steps you can take today to kickstart your investment. Okay. Why you need this? Two reasons. You need to become smarter. Success in real estate is about more than just buying property. It's about making smart, calculated moves. This guide is going to empower you with the mindset and tools to be able to analyze deals and ensure that investments are making you money and building wealth. The other thing is leveraging other people's money. What the rich are just doing is using someone else's money to buy appreciating assets that build wealth and use other people and their money to pay down that debt. That's all that's happening, right? You buy a multifamily property, 4 units. Let's say you live in one of them, whatever. You have the 3 tenants that pay the mortgage. They're paying down your debt. You're building equity. You're building your net worth, right? That's pretty much what the rich are doing, just at a large scale. 3 things you need to do. These are the essentials. So master the mindset of approaching these investments, right? Honestly, a lot of it is mindset, building a team around you, but your success hinges on you acting consistently and intelligently. So discipline to see like every angle of a deal. Ask questions like, what does this investment mean for my portfolio? What are the implications? How can I exploit this? And then the rules. So leverage, tax deductions, cash flow, equity building, and appreciation. These are the basic rules and fundamentals of real estate investing. How can I use borrowed capital for higher returns, minimize my taxes so I have better cash flow, maximize my returns, increase property value through smart improvements, adding bedrooms, bathrooms, paint, things like that, and appreciation. Profit from both forced value adds and natural inflation, okay? And then the last thing is evaluating deals. So simplified formula is income minus expenses equals profit. Does that fit your goal, right? So I would sit down and say, like, what do I need to retire? Or what do I need to quit my job every month or every year? Okay. And then you want to analyze and include all the possible income sources too. So rent, parking, and then consider all the expenses, taxes, insurance, things like that. Okay. First, starting off, when you are analyzing a property, you need to look at what's called the cap rate. That's where all the investors start. So the definition of a cap rate is a key metric to evaluate how lucrative a property is. Essentially, it tells you how much return you can expect on your investment based on that property's income. Basic formula, net operating income divided by market value or purchase price times 100. Okay, so how you calculate it, broken down, is you got to figure out the net operating income. This is the income generated by the property after you subtract all the operating expenses, but not including mortgage and taxes. Know the market value or purchase price. This is either the current value of the property or the price that you plan to pay for it, okay? How to do it step by step. Calculate the income, NOI, gross income minus all expenses, not including mortgage. Determine the cap rate. Once you have that, that's your go-to metric. That's what you're going to use. Number 3 is your annual cash flow divided by your cash invested. This is your cash on cash return. And then find your gross rental multiplier, okay? This is your gross income divided by your purchase price. These are key data points because all of it is really just math to figure out, does this make sense? Okay. Now, 2 cap rate examples, a good one and a bad one. Very simple. Let's say you're looking at a building, it's $500K value. It's got $30,000 a year in NOI, and the cap rate here is 6%. Okay. That's pretty good. The 6% cap rate is generally considered healthy for investors. If the local markets, this indicates a profitable property, assuming, stability, area, things like that. Here's a bad example. $1.5 million property and your NOI is only 50 grand a year. Okay. That's a 3.3% cap rate. Generally, you want your cap rate to be between like 5 to 8% if you can get it there. Ideally, that's where you want it. So since this is low, it's going to take you a long time to recover this investment with lower annual returns. It can be risky. And unless the value of the property shoots up, it's not the best example or not the best deal. Okay. So now that you have this information, here's the steps on how it works to use it. You evaluate the deal, figure out the cap rate, get with your realtor. Your realtor has to know this too. This is really important. A lot of realtors don't even know the stuff that I'm talking about, but compare properties, look at the cap rate, spot the opportunities, look for ways to improve the NOI or purchase undervalued properties to boost cap rate. One thing to note here is there's programs right now, FHA and conventional, where you can buy as a primary residence, you can buy a multifamily property with a construction loan that the lender will fund. So they will fund you the construction. You put 3.5% or 5% down, live in it, fix it up with the money that they gave you. And now you just increased the value of the building, which, by the way, nobody wanted the building because it was too much construction. And you now have high quality tenants because you have a high quality building if you did the construction right. So look for those opportunities as well. Mitigate risks. Be cautious with the properties having low cap rates unless justified by other reasons. Maybe you could add a unit, right? Maybe you can fix up the property. Things like that. Maybe Mark Zuckerberg is going to open up a Facebook HQ right next to your building. Like, I don't know. Look at all those other factors when buying these properties and then negotiate smartly. So based on this data, you know this. Always question the seller reported expenses. Oh my gosh, I cannot tell you how many times sellers will mess with the figures on the MLS because they want you to believe that, oh, this is such a good opportunity. They will mess with the figures. I'm telling you, it happens so often. So don't trust their figures, run your own numbers, make sure the cap rate makes sense, and make sure that they're with the gross rental multiplier, that like this is a profitable property or it will be in a couple years, okay? Request insurance and property management records. This is huge. So I would get the insurance paperwork, see what the property management records look like, get additional data, making sure that you're not risking and spending all this money on a property, on a building that's not good. Practical steps, though, that you can implement this today. Okay, so we went over all the important things that I teach my investors to look at when buying a multi-unit property. You need to review the investments, apply the cap rate formula, scout new deals, find something that makes sense, change your focus. So tackle short-term goals that lead up to your long-term goals, meaning break it down into bite-sized pieces. So figure out, is my credit, income, and assets, these three things that the lenders look at, are these dialed in for me to get the financing I need? If not, start there first before you even start looking at deals. Once you have those three things dialed in, now you can start reviewing investments, scouting deals, and break it into pieces, like learning different steps before you buy your first 3 or 4 unit building. Okay. Now, most of the time I'm talking about 2 to 4 unit buildings because that's residential. The loan parameters are different. When you start buying 5+ units, the game completely changes. Commercial loans are different and qualifications for them are a little bit different. But those are the things that I would start implementing today to start looking at deals. And even if you can't buy a building right now, it's good to know these things and just practice. Like, start looking at properties for sale and get ahead of it. These are some important items. Calculate the price based on the cap rate you want. So determine like what you're willing to pay for the property based on what cap rate you want and what cap rate you're comfortable with. Negotiate to that price. Don't ever trust the seller's expenses. Ask for insurance and property management information. Change your focus for different emotional and outcome changes. One thing to note too is like, this is an emotional ride. Like, it's a roller coaster. Like, things will happen. Things will come up. Be prepared for the worst. Hope for the best. Be prepared for the worst. And then use cap rates across states and property types. So they change area to area, city to city, state by state. Remember the rule of 72? So this is if you want to estimate how long it'll take for an investment to double at a given annual rate of return, you can plug in that formula. I'm not going to get into it. You can look it up. Deal and money. So we call it DAM. This is one of our investors came up with this. Remember that in real estate, all you need are solid deals and the money to fund them, right? It's simple, but it's not easy. If it was easy, everybody would be doing it. But it's fairly simple. Find the deal, figure out how to fund it. Okay. Theoretically it's simple, but the practicality is leverage the big banks, figure out how to get your financing right in order to be able to qualify for these loans. How it can help you is look, if you're looking to build wealth, I help investors maximize portfolios with the right financing strategies. I help people leverage the bank's money because I'm a lender, I'm a mortgage broker. I find the best financing available that they can for their building and stay connected. I have resources that I'll also have in the description and on my website. So if you want to find free tools, free guides, that's better than anything you'll find on the internet. That's what I'm going to have on my platforms. I hope you found value in this. My name's Ben Steff. Feel free to subscribe and follow me for a lot more content just like this. Thank you.